Are you ready for more financial modeling in Excel? If so, this is the video for you as we'll pick up from where we left off in part one and now start building a balance sheet in Excel. Along the way, we're going to learn about different types of assets, liabilities, and owner equity, and we'll discuss how the income statement and balance sheet relate to one another. They impact one another. If that sounds good to you, let's head over to Excel. Now it's time to put together a balance sheet for this hypothetical corporation. I'm going to scroll up to the top here, and we have a label here for our income statement. We want to bring that down, and probably the years as well. We'll copy and paste the years too in this case. I copy that entire section, scroll down. I have a long Excel workbook in this case, and let's call this the balance sheet. I'll give that a orange color here. Perfect. And now let's just go ahead and set up our labels for starters. The first section here will be called, well, we kind of need a global section first, and that'll be our assets section. Assets. There's really three sections primarily on a balance sheet. There's your assets, and then I'll list those out, and then eventually we'll get to our liabilities, things like debt, assets, things like cash and property, liabilities, and then equity. And there is a classic formula in accounting and finance, and that is assets. Your assets equal your liabilities plus your equity. So we'll need to make sure those two things ultimately tie out. Let's talk about some of the assets we might have in an example. Every company will look a little different here, but first there's current assets. Those are more liquid assets. So we'll give that a label here. Now this could come into play for, it's a technique you could use for all kinds of Excel spreadsheets, but especially financial ones. I'm going to insert a column before column C here. So I'm highlighting column C, right clicking, insert. Watch this. I'm going to take this left side of C to kind of make B a little bit smaller. Just want a slight indent is kind of what I'm trying to do here before our actual year columns start. And now I've created a place where I can add sub-current assets, things like cash, and I'll do accounts receivable, money that maybe our customers owe us that we haven't gotten paid yet, so it's not cash, and maybe we've got some inventory, golf clubs laying around, and then we have fixed assets too. Those are kind of more less liquid assets. So fixed assets, and maybe we have things like land. Maybe we've got some equipment we use to create the clubs, and depreciation. Very good. And then we'll create a placeholder for total assets where we'll add our current and fixed assets so we can see in one column, one row, what all of that adds up to. And make sure that it ties out with our liabilities plus equity, because again, that is a formula that needs to hold true in accounting. I'm going to delete an extra row here. And well, maybe we'll start just populating this for now. Our current assets will ultimately be simply the sum of our cash, accounts receivable, and inventory in this case. I'm just gonna highlight these cells, and you can see it uses the colon to say all the cells between these two. We want to sum those, and I will drag that to the right. I'll center. Now I just realized, let me scroll up here. Okay, good. We're using the dollar format up here. We want to use the dollar format down here as well. Maybe I'll save that to the end to do, but eventually we want to format these as dollars. Cash. Ooh, cash is an interesting one. Now for the first cell, we should probably have some kind of maybe a starting cash value. and that we will set as a parameter at the top. So let's scroll to the top, just put it before our starting sales value, starting cash value. Let's say we start with maybe 150,000 here. Highlight that as an input. Great. We'll just simply point to that. I guess similar for probably all of these, we might want to set them all up as inputs at the top. So we've got our account receivable, inventory, land. I'm just going to go ahead and scroll to the very top here, and let's paste them here temporarily. Create some additional rows, some space to put all of these parameters. These in the first, maybe move some of these things around. I'm going to do Control X to cut, Control V to paste. Same thing with this, Control X to cut, or we could right click and highlight all of them and right click and say cut, and then right click here and say paste. Manual way, non-keyboard shortcut way to do it. All right, so we have those labels set up, and now for accounts receivable, we'll say we'll start with $5,000 in accounts receivable. Maybe we do $10,000 in inventory. Let's do maybe 200,000 land. We'll say we start with 100,000 in equipment and 75,000 in depreciation. I'm going to highlight all of these. These are just made up numbers. You can make your own assumptions here, and the great thing about parameterizing them is at the top is you can change them here if you want to, and everything else is linked. We'll update from there. So I might left align all of these. There we go. All right, now we come down to our balance sheet section, and we simply point account receivable, row 60 for me, to starting account receivable, point inventory to our starting inventory level, come down here to fixed assets, point land to land. Now we have these in the same order, so land, equipment, depreciation, so technically I can now drag this down for equipment and depreciation, and that looks good. I'll go ahead and get everything centered here. I'm going to scroll back up. I noticed that this is not dollar format. Now I could right click and change the format that way. Format cells, I can always do that. Or I can just find one that has the format that I want, like this one that has dollar signs, format painter, click on the cell that I want to have that format, and there we go. So that looks good. Now I forgot to add starting in front of these, and I think that would be helpful to denote that these are the starting values, basically what the values were at the beginning of 2023. Go ahead and save. Scroll back down. All right, looking good. I'm going to go ahead and update the format of this 165,000 now using the format painter. Looks good. Fixed assets, similar to current assets. In fact, in this case, we could just Control C, copy that formula, Control V, and it's just doing the same thing. It's summing the three rows below it. So that works out very well. And our total assets would simply be our current assets plus our fixed assets. Easy as that. It adds up to 540,000. Looks good. Let's see here. For our accounts receivable and our inventory and even our fixed assets, I'm not going to assume that these change much from year to year. We're going with a really simple model. I wanted to include them here because those are typically seen in a balance sheet, but I'm just going to assume that these stay flat. The 5,000 stays relatively flat year after year after year. Maybe it's different customers that owe us year after year, um, hopefully things are being paid, and new lines of credit are being opened up. Similar with inventory, drag that over. And I'll make the same assumption with land and equipment and depreciation. I'll just assume that all of those things are staying relatively constant year after year, especially in our no change example. And I'll drag that over, which will always be the sum. Cash is going to be an interesting one. I'm going to come back to cash. That'll be a plug number essentially. Eventually, go ahead and center all of these up. Yeah. Okay. Gonna just apply that formatting here. There's another one, inventory here. I'm gonna update that to have a $sign in it. All right, our asset section is looking pretty good right now. Now it's time to move on to our liability section. And similar to how you have current assets and fixed assets on a balance sheet, you'll usually have current liabilities, should be your more short-term liabilities. So we'll have things like accounts payable and maybe deferred income. So accounts payable, money that we owe maybe our vendors, and deferred income would be money that maybe has been paid to us already, prepaid to us for things that we haven't delivered on yet. So it hasn't been recognized as income yet. So that'll be our current liabilities there. And then we'll have some long-term liabilities, like maybe we have some long-term debt here. So that'll be our only long-term liability value in this example. I'm going to insert some space here to also create a total liabilities line item. Current liability simply going to be the sum of these two rows, accounts payable and then deferred income. Go ahead and drag that across. Now here again, we need a starting accounts payable value, a starting deferred income value, starting debt value. I'm going to copy these titles up here so that we can easily add them in. Just 3 more rows for these. Doing Control X, Control V again. All right, what do we want to use as our starting accounts payable value at the beginning of 2023? Let's say our accounts payable and what we owed to our vendors, $10,000. Let's say we had about $5,000 in deferred income at the beginning of 2023. Let's say our debt was $100,000 at that point as well. Left align, highlight, keep your formatting consistent. That is so appreciated by your stakeholders, anyone using this. It's just easier to follow when formatting, coloring, alignment is consistent. All right, so we're going to point to our starting accounts payable value. I can drag down for deferred income, and then I'll go to the debt line here, point that to the debt line here, our parameter 100,000, and I just realized we need to add starting in front of these as well. Like we talked about in the personal finance example, creating parameters at the top is not just limited to Excel. It can apply in SQL, and it definitely applies a lot in Python, setting variables and then referencing those variables later. It's a great practice. Very easy to find anything you would want to update at the top of your code, at the top of Excel. It's a good practice. Okay, this is looking good. Now, let's see here. Similar to our current assets, most of them except for cash, uh, we're going to try to keep these consistent. Our accounts payable, our deferred income, our debt, we're going to just assume that those stay pretty constant. That won't be the focus of this exercise. In real life, if you felt like that was a bad assumption, you could update that. Our long-term liabilities in this case is just equal to debt. That's our only line item. You could add more if you wanted to. I'm going to need to update our format of our current liabilities. Our total liabilities will simply be the sum of the current liabilities and the long-term liabilities. Drag that to the right. Then we'll center everything up. Okay, that's looking good. Now, let's put a line between here. Since there's a lot of cells being added here, let's just go ahead and put a line that denotes that there's some math happening here between adding the current and long-term liabilities. Similarly, up here, insert another row. Let's put another line below here to denote that this total assets equals the sum of current assets and fixed assets. And I think that's looking pretty good. Now there's one more section, the balance sheet, and that is the equity section. Okay, we've already put space for equity. The first line under equity might be paid in capital. And that I guess would be fairly constant unless the owners are taking money out of the company. So we'll say at the beginning of 2023, our paid in capital, it could have been paid in years ago, but we're starting everything here. We're showing 2023 and beyond. Say that was 20, well, here again, let's create that as a parameter at the top. So maybe we'll do that. But then we'll have retained earnings. Now, what have we earned? What was our pool of earnings beyond just our paid in capital? What was our retained earnings at that point? And then let's also capture what our current year earnings were. And when we sum all of those up, that will equal our total equity. And then we'll have another line item down here for total equity, liabilities and equity added together. Because remember, the sum of liabilities and equity equals our total assets. So we'll want to make sure those line items tie out. Okay, so we'll go ahead and copy these to the top. Retained earnings is going to be unique. We'll come back to retained earnings here. But current year earnings, actually, that'll be a calculation. We'll simply be pointing to our income statement. So the income statement and the balance sheet, they influence each other. Again, we're going to have to calculate interest earned and interest paid based on balance sheet fields. And then some of our balance sheet things, like our current year earnings, we will actually be linking to this net income cell here. So they work together. The balance sheet and the income statement, they influence each other year after year. We'll be able to drag this across to capture our current year earnings. We can go ahead and just do the math here, adding up all of our three line items in the equity section to get our total equity, and then adding our total liabilities to our total equity to get our total liabilities and equity. Might as well. And we'll just drag those over. Yeah, looks good. I'm going to copy this formatting for now. We still need to set our initial paid in capital parameter. Just paste that here. Insert another space. It's good to have some good spacing in your Excel workbook or presentations as well. Paid in capital, we'll assume that starts in 2020, at the beginning of 2023. Our paid in capital was 25,000, let's say. And I'll highlight that yellow and left align. And we will point this at 25,000. Great. Now this is another thing. We're going to assume that we are not adding in capital or taking out capital from the business, and so this will remain constant as well. for simplicity. Center everything up here. Okay, so retained earnings. In order to calculate what our retained earnings were at this point, um, technically we have this formula around assets equals liabilities plus equity. So what we should be able to do for this first year for retained earnings to figure out what number would make sense here. Maybe we have the number we could plug it in. In this case, we want everything to make sense. So we're going to say, we're going to start with our assets, and then we're going to subtract out our liabilities, and we're going to subtract out the other parts of equity, paid in capital, and our current year earnings, and that will get us to a good starting value for retained earnings. Just a simple way to get there very quickly of what, and with these starting values, what our starting retained earnings should be for 2032. And what you notice, because we kind of set it up this way, but now our total assets equal our total liabilities and equity. So we've got some good starting numbers there. Now going forward, we should be able to calculate what our retained earnings are for 2024 and beyond based on what was our retained earnings for the prior year plus whatever we earned that year, and that should equal our new retained earnings in theory. So let's drag that formula over. It's always whatever we started with in retained earnings the previous year plus our current year earnings. I've drug it over. Very good. Now then, we need to come back up here to our cash. The idea here is that the impact of our earnings, essentially the impact of any net changes here, that just fluctuates our cash balance. We're going to assume that accounts receivable, inventory, all the other things, debt, accounts payable, all that stays constant, and the only thing that that responds to earnings is, hey, if we made a lot of money, we add that to our cash balance. If we lost money, we remove that from our cash balance. It's a really simple way of modeling it out. So in order to do that, we'll do kind of similar to what we did with our retained earnings. We'll basically say, okay, well, our cash balance, that would be equal to whatever the total liabilities and equity were for that time period. So in this case, this cell. And we're going to subtract out, so our assets have to equal our liabilities plus equity. So if we start with our liabilities and equity, and then we just subtract all of our fixed assets, and then our other current assets, our accounts receivable and our inventory, that'll give us our cash balance. I'll right click, we'll just drag that over. And there we go. So if we see what happens here in 2024, we expect our starting balance in 2023, a cash balance of 150,000 to go up to 189,000. That is essentially a reflection of the 39,000 that we expect to make in 24,000. That's what gets us to that cash balance. All right, so we have a populated balance sheet here. We have a populated income statement here, and it's all for this scenario where we don't buy the putter company. All right, before we move on to the income statement and balance sheet in the change scenario, I want to update a few things. One being the interest rate on other assets. So this will be the interest rate that we earn on our cash. This is actually going to represent the interest rate that we pay on debt. I'll make that update. That'll pay 8% there. And now that we've established our balance sheet down here, we can come back up to interest earned and and start populating these cells as well. So our interest earned would be a reflection of our cash balance, and we would multiply that by our interest rate that we expect on cash. I'm going to lock that in. There we go. We'll drag that across. We're getting an error here about circular references. Okay, we want to think about whether, I think right now we're thinking our balance sheet kind of represents more beginning, or we'd have to establish whether it represents the beginning or the end of that year. What we'll do here for cash for interest earned for now, for simplicity, is we'll say it's a reflection, at least starting in 2024, of what your cash balance was the year prior. It'll be that times the interest rate on cash, and then we'll lock that in. Now we should be able to drag that to the right and do just fine. We'll take a similar approach for interest paid. So we'll start with what was the value on our balance sheet of our long-term debt. We're going to multiply that by the interest rate on debt, lock that in with F4 or dollar signs manually, enter, and again if we drag this across, oh, that actually does okay. But we could base this however we want. And the debt level we are expecting to stay at a pretty constant 100,000 below, so that's why it consistently assumes 8,000 paid in interest. Okay, so we've populated those. I'm going to center everything. If you like this video, I hope you'll consider liking it for me. And if you'd like to see more analytics, data science, and leadership training videos, please consider subscribing to the channel. Finally, if you have any questions on what we discussed today, please leave a comment and I'll try to respond to it as soon as possible. Thanks again for watching, and I'll see you in the next video.